Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's Deal Deep Dive episode, we're joined by Brian Ferguson. Brian is going to share about his 18-year real estate career that started as a fix and flipper and has now built a massive real estate holding company with a fix and flip division, syndication division, in multifamily and commercial real estate, as well as a capital fund. Now let's welcome Brian Ferguson. Welcome back to the Westside Investors Network. We got Brian Ferguson with Fergmar here today. Brian, thanks so much for taking the time to talk with us.
Hey, Trent, appreciate you having me on, man.
So I had never heard of Fergmar before our conversation today. For the listeners who haven't heard of it, what is Fergmar and who is Brian Ferguson?
Well, Brian Ferguson is half of Fergmar. So my business partner is last name Martinez Ferguson. So Fergmar is where it came from. It evolved after years of trying to come up with names that were existing words. And over time, we realized that there's lots of big companies that name it whatever they want. And so we just put some meaning behind our names and Fergmar was evolved.
I love it. And it's memorable.
Yeah, it's better than one of our original company was Platinum Home Investments, super unique, right? And then so Fergmar a lot of people are like, what is that? But then once you see it, they know it, that's associated with us immediately. So that's our parent company now.
And you guys didn't start as Fergmar, you and Brian?
No. So we started as Platinum Home Investments. That would have been, and we're right at 18 years ago now as a fix and flip company. Fergmar was initially established. We created that name probably 18, 19, and then really within the past 2 years, we had tons of different divisions with tons of different names, and we've been putting everything together, even getting rid of some of the divisions and just still doing everything but operating under that Fergmar brand.
So you guys started as fix and flippers. Was that local in Victoria, Texas as well?
Yep. Started out just doing one or two. We both came from the car industry. So my partner and he was a sales manager. I was in the finance realm, and we were fixing and flipping a few. We actually had a third partner at one time, just, some guy that had some rentals that we thought had all figured out. So we partnered with him and then did one, then two, then we were doing a handful. We both left our job. He left first, and then I left. And then, we went from doing a few to doing, we've done upwards of 150, 200 transactions a year. Just to, some years a few less, some years a few more. So we still have that division today. It's a large piece of our cash flow and of our our setup here. And then that just evolved into, we got into it in 06, 07. So, not the most fantastic time to be getting into real estate in hindsight. Taught us a lot though, taught us how to run lean and to be in a challenging market, which has been helpful recently. And then we ended up stuck and holding, a bunch of properties that we couldn't sell, turned those into rentals, eventually sold those off when the market recovered, bought duplexes, fourplexes, sold those off, got into multifamily, and then eventually got into commercial. So it's evolved over time. We have a ground up new construction division, land development division, and then we also own and manage our own property management company and construction company.
So I guess, were you kind of forced into the buy and hold because of the timing of when you guys were trying to flip these?
100%. Yeah. If you would have asked me in 2008 or 9, I thought people who owned rental properties were dumb, didn't know what they were doing, because I could buy a property and go make 20 grand or 40 or whatever it was faster. Why would I possibly want to wait a long time? If you ask me as I'm only 38, but been doing it 18 years. But if you ask me as I sit today, I would tell you my biggest regret is that I did not buy bigger and hold much longer. I mean, what we did was, I don't think we could have changed that much. Even if I'd have known the syndication route the way I knew it, I still wouldn't have changed any of that because we needed the cash flow back then. But I wish I would have bought bigger, faster, and held. And we didn't. There's plenty of properties that we've sold and I wish I still owned today. But that was my mentality back then. We would rent out what we had to. And even in recent times, even in the past few years, we have, because that division's so big and we have kind of that Swiss Army knife of what we can do with it. We've just recently put some, we're not really into the single family holding, but we just took some, even a couple new construction houses that were sitting and we transitioned them into the rental fleet, and we'll lease them out and let them sit for a couple years. And once that market's strong enough, we just rather do that than sell at a loss. And that's what we did then. We just did it to the tune of, hundreds of doors back then and held on to them. But, you had stuff you'd buy at a tax sale for $15,000. You'd put, 10, 15,000 in it back then, lease it out for 800, 900. And then over time, well, before you know it, you now have a $150,000 house in 2018 or 19. So, or probably 16, 17 is when we started exiting a lot of those. So it worked out well, but we were definitely it was by force. It wasn't by choice.
And so you did that, you said until you did that, you basically held them for what, 8 years?
8 to 10 years, some of them. Yeah. And then sold off one or two of them and saw this 1031 thing we became experienced with, and, saw how much equity we had. And most of those we had financed because we'd only financed for 5 or 10 years. So you can imagine at this 8-year point, these things are almost paid off. So one or two sales was enough to buy us a nice 4-plex or 8-plex. And then at that point, things started happening much faster. But eventually we had exited all of them. But yeah, almost probably 8 years, we held most of them.
So your guys' trajectory went from fix and flip, we're going to be property managers because we have to. And then in that 2016, I guess, were you adding more properties to your portfolio during that 8-year stretch?
Yeah, we had determined the foolishness of not holding on to long-term rentals already, but we were adding, duplexes, 4-plexes, 16-plexes, 21-plexes, things along those lines. And because you fast forward a little bit, skipping around, but 18, 19 is when we added our first 100+ complex. We had hundreds of doors, but it was what we could buy at a time, 15, 20, what we had cash built up and we could buy at a time. We had done that along the way. Then in 14, built a few spec houses because we had some lots left over. Because we're not, when I say fix and flip, it was definitely single family. We'd flip commercial buildings. We'd buy land, buy a couple hundred acres, chop it up into ranchettes. We've done quite a bit of that. So, and then we ended up with some leftover lots in 14, built some spec houses. And then that evolved into we started doing subdivision development, putting in full subdivisions, building. At one point, we probably had 50, 60 between specs and customs going at a time before COVID. So we had a rather large new construction division as well. So, but a lot of things it started in that fix and flip world with a few houses, and it just evolved into these other things. And a lot of it happened because our market, you get capped on what you can do in the market. So we would expand, instead of expanding into other markets, we would just kind of widen our spread of, okay, what else fits into what we do, instead of going and fixing, flipping houses in Houston or somewhere else. We would stay in Victoria and just keep touching other things. And some of those things have been, which we don't do this anymore, but, we owned laundromats. We had our own showroom where we sold product and appliances. So we've done different things along the way, just because it allowed us to expand more in our market.
And so when did the syndication arm of your guys' business first get going?
So our syndication is the one named differently. It's Altunis Capital is our syndication company, or our capital company. But so that was late 21, early 22. Actually, it's a funny story because I booked a conference in Houston. It was actually right at the beginning of 22. And we had never taken outside capital, maybe some private hard money loans, but never had private capital prior to that. And we had this 134 unit complex. We already knew, like, this is where we want to be. We can manage this with 2 to 3 people, and we see what it takes to manage the same 100 and something doors over here on, mixed with 4-plexes. As New Year's, I'm going to book a bunch of conferences. I really wanted to travel and expand my knowledge. And I booked this multifamily investor network conference and thought, okay, we're going to go and learn how to be more efficient on the properties we own. Well, it was a full-blown syndication conference. And I realized that in the first hour, that, like, they served the pastries and coffee, and then they started talking, and I was like, this is not, and I'd heard about it, but never dove in. And that was in February of 22. I had a deal under contract by April, May range, and we closed probably late summer on a shopping center. So it moved pretty quick at that point, just because of the years we had in and the contacts we had.
So now where does Fergmar sit in terms of, I guess, focus? Are you guys focused on syndication now, or where do all the different facets lie?
So Fergmar is still the parent company. It employs everyone. Fergmar as its main focus in Victoria. We're known for we still have our fix and flip division. We have a full acquisitions team, dispositions team. We own and hold a bunch of assets, the property management piece of it. And then Altoona still has as the capital company that we go out and raise the capital. But our focus now is we still have the fix and flip. We're actually gearing that up and doing even more than we've done in previous years and expanding that. And then we're still doing our new construction. We're mainly just specs, but we have a bunch of subdivisions sitting on the ground. So now that we've kind of gotten through this whole, rates have started to come down a little bit. The market's picked back up. So we're building some of those again. But our long-term goal is we sit, in that 5 to 10 year especially point, we want to be primarily a large holding company for multifamily and retail. So we've definitely honed that back in to say those are the only things we're doing. And then as far as what we buy and hold, like for instance, we have some self-storage we've bought. We're not going after that right now. We are going after multifamily that can support on-site staff and neighborhood sizable retail shopping centers, something in that 10 to 60,000 square foot range, surrounded by a bunch of rooftops.
Very nice. When it comes to the syndication side, obviously you guys have experience in operating deals and managing deals. On the syndication side, I know you said Altunis is a capital company. Are you raising the capital and managing these deals, or are you placing capital with other GPs that may be operating them?
No, we're raising the capital through Altunis and placing it with our own deals, and then we manage those deals as the general partner through our management company, which is right now we're managing through Altunis. We haven't placed in other deals. Now, that being said, I am invested in other deals. I'm an LP in a handful of deals, and still will consider some of those today. Just kind of depends if it's right. But, the main reason we started putting those deals together is because as we would sell off assets, we had a 1031, we could only buy, we'd sell X and then we could only buy X. But we knew the efficiency was in the larger deals. We saw the opportunity for it. And so then I started placing my own personal money in some of these deals as an LP, which, a lot of people think is crazy. You have all these things going on. Why would you put it over here? Well, I know what I'm able to buy in our organization with these funds individually or, as through our company. But I see these deals over here that I know are going to have far phenomenal returns in 3, 5, 7 years. So I wanted to place my money there. So the whole reason the syndication, really our focus was to somewhere it's a vehicle for us to place our money in. It's just our money is not always enough to do the deal by ourselves. And that's why we bring in partners. Our partner group is selective. It's not like, we're everywhere on marketplace and just every $25,000 someone wants to put, we place in. It's not that at all. I still personally, I talk to every investor, vet them, make sure they're a good fit for us, because we're not just doing a ton of deals every day. But again, the main reason was because, I place money in every single deal. I wanted the right deals. I'd much rather put $100,000 in a deal that I'm managing with our property management company. For instance, I sunk money in a deal in Houston. The guy I thought was just on fire. And now I probably won't see that money because the deal is going the other way because of poor management. So it was right after that deal that really had me start putting our own deals together for that reason.
There was a good opportunity for a joke there, but I'm not going to do it because it sounds like you're going to lose $100,000, but or lose money. I don't know what the number is, but you said it was on fire. Now it sounds like that capital is on fire, unfortunately.
It is, I call that a training pay. When I was going into those deals, if I wouldn't have done that, I wouldn't have learned and been able to put together. So to me, I don't lose any sleep over it. I definitely didn't. I haven't funded my capital call. Not that I should probably be saying that online, but there was I didn't vote for the capital call either because I don't want to throw good money after bad. But yeah, some of those deals I looked at it as, and some of them are doing well, but the knowledge you get from those, sitting there listening how other people are doing it, whether it be good or bad, that's invaluable to me. And people pay that or more to go to some of these conferences around the world. So
yeah, and that was actually my next point, is being an LP definitely helps as a general partner when you start operating your own deals, because you know what to do and what not to do, which, I mean, like you said, it's invaluable.
Yeah. I mean, having our history and then being, 15 years before I started placing my money in other deals and then circling back and putting our own deals together. Cause most time you see people become an LP from a really good W-2, then turn into a GP. Well, my W-2 was real estate investment. So it's been quite the journey for me on it. I looked at, man, I don't want to flip houses forever. I got some money. Let me put it over here. Maybe this is my retirement. And then I realized I'm young. I got plenty of life left in me. Let me go put deals together and let's chase retirement that way.
So, and I guess I forgot to ask you, when we first were starting this conversation, but you started in the car business. What initially got you to the real estate? I know you said you started flipping, but what made you want to flip the first one?
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
I wanted something that was long-term, but the car business is definitely one of those things. We'd work 80 hours a week, 6 days a week, and then you'd see someone that was doing amazing. And then the next quarter, they're terrible or they're amazing for 3 years. And then they're gone 2 days later. Maybe some people will watch this and not agree with me, but there's no longevity in it. It's good cash at the time if you're good at it and you're willing to put in the hours, but there's no longevity in it. And I knew I always wanted something that was my own. And real estate I started with the old original Flip This House show. I watched them. I was intrigued by it. And I mean, to this day, don't get me wrong, we have stressful days, but there's not a day that I may be tired at 5 a.m. when I get up to go to the gym, but by the time I get in my desk, I don't regret, or I'm not looking forward to the weekend other than the fact I want to spend time with my family. I love doing what I do every day, and it's been that way for 18 years now. So
I think you made the right decision.
Yeah, me too.
So we've covered all the different avenues and arms of your guys' companies. We talked a little bit offline about a deal local to you guys in Victoria that maybe wasn't or isn't one that we've talked about on this show, before. Can you explain this deal? I guess I'll just preface this with, it was a single-use conversion, retail, commercial space. I'll let you get more into the details. But tell us about this deal and what made you guys want to explore this route.
So a few points there on that. First, when I said, we talked about a lot about how we chase multifamily and the piece of that is when we got into syndicate, what I realized was that's when it was just so heavy in multifamily. Everyone was buying them. Cap rates were so compressed. You couldn't get your hands on nothing that saw the numbers we wanted to see. I definitely saw most of those deals as being, you got to get in and get out at the perfect time. And we like to, while we do show 5-year exits, which may be from a refi or we'll buy partners out, I look at things that I want to see in 15, 20 years. And if I couldn't see that, I don't want to go into it. But so that's what pushed us into retail. And then we pulled down, we were able to get a couple centers, existing retail centers that had value add from just better management, better advertising, what have you. But then that got tougher as well, finding enough of those, again, in our market or similar size markets. And then I just really started, I like to think of where can we separate ourselves? Because you go to a lot of these conferences and you can go to 10 tables and 10 GPs that are starting out, and it's almost like they memorize the same pitch from a book somewhere or some class. And so I just was trying to think what helps us stand outside the box. And, people would say, okay, retail's dropping. And I don't believe that in our smaller retail centers, but those big single-use spaces, I did see that. So then our approach became, can we go after these single-use buildings that are virtually useless or are very low value because they can't fill them? And so that's how, and this was our first one that we acquired in this sense and converted. We'd done some smaller ones, but not at this level. So it was a 27,000 square foot It was originally built as a Mr. Gatti's Pizza, added onto it multiple times. And then the guy had a Mr. Gatti's franchise, opened his own franchise. And then super interesting deal. The guy owned the building, sold the building with this long-term lease as a lease back, ended up closing down or going bankrupt like a year later. So the investor that bought this out of New York was stuck holding the building, leased it to a church for dirt cheap for years. The church ended up building their own facility. The talks were this building needs to be demolished, torn down. There's bats in it. It's terrible. But it was a 27,000 square foot structure with about 12,000 of it being a 10-year-old metal portion in the back. It also sat on a couple acres off of, which it's a road, the main thoroughfare here, which you can't buy. You'll spend millions just to tear something down now. There's nothing left on there. There's no land parcels. So just the concrete parking and the structure, the value is there. So we approached the seller direct, bought it. And again, this was our first major. We knew what it could be at the end. We had budgets going into it, but I mean, it was just a small example, we had a bid to trench through the concrete, to lay the concrete, to lay the plumbing lines. And remember the GC calls us, this is getting early in, and says, oh, well, apparently they laid 4 slabs on top of each other over the past 50 years. Well, so every inch, you had to pay per inch of cutting per foot. Well, this is a long building. So, and then getting rid of the bats was one thing. And then realizing that they had stacked these roofs on top of each other. There was an old awning it was one thing after the other. So tons of overages. And it was quite the ride getting through all of it because of the size. And it was 4 buildings that had built onto each other over the years. But it created at the end of the day, still, if you take the initial acquisition, the money we had to put into it, if we had to do it ground up, it would have cost double what our total cost is now with the same finished product.
And so it started as one unit, right? And your plan going in was to chop it up and make multiple units. How many units did you guys want, or did you guys end up doing during that phase?
So we ended up with there's a total of 8 suites in there now, but one of them is a 12,000 square foot, like state-of-the-art fitness facility, largest, nicest one in town. And then the one next to it's a 6,000 square foot. Think of like a boardroom salon that you'll see in Houston or the bigger cities. And then it has a men's and women's salon total. So about 6,000 square foot. So they ate up a bunch of the space. And then the other 6, then you have then individual suites that range between 1,500 to the corner suite being about 2,200. So it mixed up a restaurant on the corner and then just some miscellaneous businesses going in there now.
And I know you said you plan to hold it long term. What is long term for you guys? And do you have, I guess, projected returns that you're targeting in order to deem it successful?
Yeah, absolutely. So at one point you asked earlier about kind of what is our reasoning for it. One, we do it we're building a portfolio, returns if we have investors, or returns for ourselves if we don't. But, Fergmar, our slogan is enhancing communities through real estate. And that's a big piece of it for us. You're taking this old building, we've enhanced it. It changes the whole jive. And we're actually doing a survey right now on, we recently did on how many employee count, like how many people how many employees have been added to the workforce here by these businesses opening that didn't have space to open before. And then just kind of goes full circle on they're employed, they can put their kids to a better school. So just seeing that first full circle is a big piece of it for us. So that piece of it alone is a success. It's kind of why we're not really into these single use buy Walgreens all around the world and put a fund of funds together, because that doesn't really fit with our enhancing communities. We didn't do anything there. We just bought something someone else did. So, but this particular deal will be averaging around a 3x by the time it's stabilized. We're 2 years in and we still have a few vacant suites, but so going into probably Q2 of next year, it'll be it'll be a double-digit cash on cash easily. And our goal, so if investors are involved, if we have, and we're structuring them different now, but previous ones were structured, that 3 to 5 year, we knew these guys wanted to exit. And so we make it very clear, and it's in all our operating agreements, that we have the right to buy out at market value at that time. So, And we also structure them to where most of all of our and that varies by deal, but we get very little in the beginning, very little throughout, if anything, throughout the deal, other than, if we're property management. But we're trying to pay back that investor's capital as much as possible. That way, at that exit time frame, it's easier for us to, if we've done our job right at 5 years, we should easily be able to refi it, maybe inject a little bit more capital of our own. But every piece that we would have had in the deal would stay as equity when we go into the refi, and we're able to buy the investors out at that projected, whether it's 2x, 3x return. But the development play on those and turn them into retail allows you to, it takes a little bit longer to hit the cash on cash, obviously, because we have that redevelopment cycle that has to happen. But once it happens, we can hit the cash on cash projections for whether it be a 2 to 5, 7 year holding period, and the exit is beautiful. So you get both pieces of it, which underwriting existing deals, I'm not saying that doesn't exist. We don't have a lot of luck finding the ones where you can check both boxes.
Yeah. And how long did that redevelopment period take?
So we purchased November of 22. We already had the second we went over, because I saw it, we contacted the owner. We knew the deal was happening. We were under a feasibility period. We had been for a few months. So by the time we closed in November, I already had the first tenant for the gym secured, was working on the salon. And then we moved the gym in. They had their grand opening. It's coming up on a year. So I believe it was October 1st of 23. So they've been in there right at a year. They were the first space we delivered. And then we delivered the salon probably middle of Q1 this year. And then we started delivering a few other spaces, and they just leased another one. So we're down to 2 spaces left. So hopefully we'll go into Q1, fully. So a little bit longer than we thought. We definitely had construction delays. We were expecting to have the entire center delivered, all spaces, within 12 months, which would have been the end of 23. And then the lease up has been taking a little bit longer on that particular space. Main thing we account that to, both of our anchors are in the back, which is because they're not necessarily, they're the type of business, they need to be off that main thoroughfare, but they don't need the frontage. And it was a lesson learned on this one, is getting someone in that front space, because it just has that vacant feel. And so the second we saw some activity there, that activity has created activity, and we're filling the spaces faster now. But so it'll be about a 24 to 30 month, probably 30 months by the time we're fully stabilized from the date of purchase. But again, this was a $4.5 million, 27,000 square feet construction project.
Yeah.
So
big
task.
And because obviously you've done multifamily too, and especially when you're buying standing multifamily, you're getting cash flow or at least revenue coming in right away. With something like this that was sitting vacant, plus you had to do the redevelopment. When you're talking to investors on this, are you just saying, hey, you're not going to see a dollar for the first 2 years, or how do you approach that conversation with investors? Yeah,
absolutely. Because we have an active deal now. It's a 2-pack portfolio that had a redeveloped gas station and a redeveloped Blockbuster in front of a mall. I think it's just amazing location. But we're just very clear on them. When we show the projections, that one was a little bit faster. But if it's 0.5% cash on cash in year 1, or not by year 2, we just show them that. But that average cash on cash is still a nice number when you can start hitting those double digits once stabilized. And then the exit is normally so nice on those. And then like this recent when we packaged it together, because one of the properties was a smaller redevelopment, and we knew it would start producing cash flow faster, but it didn't have as big of an exit. Whereas the other building was going to have national tenants, and we could probably get a very compressed cap rate at that. And we packaged them together. That way we'd get a mixture of that cash flow and nicer exit at the end of it. But yes, we're just very upfront on it. One thing I'll point out on the multifamily is you go buy 150 units, unless you evict the whole complex, you're gonna be 24 to 36 months, what we call, if you want to call it, fully stabilized in the way I underwrite a deal. Because by the time I turn all those units and get these value add $300 add-ons, it's going to take a couple years to turn all these people. You'll hear a lot of people go, well, we're just going to raise all the rates at all the renewals. That's a good theory, but unless you're creative, you're going to lose people. And again, that's going to take time too. So when I say, let's say we go into Q2 on this 27,000 square feet, that is, construction is completely done, and we are 100% occupied with everyone at a full market rate. And I think a multifamily deal would take you similar time frame regardless, but I treat them as a ground up. I tell you, yes, there's a building there, but call it a development project. It's if I was going to go build an apartment complex tomorrow, this is the same concept.
I like that. I like that way of thinking about it because I mean, I have friends that do development, and I've always asked them because we only do existing multifamily, and you start collecting rents the day you take over, right? And
Yeah.
for him, he's like, yeah, I mean, I I don't pay investors for 2 years pretty much because they're all
Yeah.
ground up, have to get them leased and everything like that. So
It
that's the
has to
main
be the right
difference.
investor. If I sit down with someone and I go, we start, we kind of, we can go through a bracket process and, we go through fact finding. And if I tell them, what is your goal? And they go, oh, well, I'm a lot of our, like a big piece of our avatar, we have probably two different avatars that are attracted to, but one of the main ones is that, probably 40s to 50s male that owns their own business that is looking for that retirement piece. And if they tell me, no, I mean, I have X amount of dollars, and in the next few years, I want to retire, and I need the cash flow from wherever I invest this, and that's how I'm going to pay my car payment or buy my groceries. I'm going to tell them, no, this is not the deal for you. Let's show you this multifamily deal over here, and that's why we're in both spaces because we like both spaces and we do fairly well with them. But I would shift them there. I would not let them put money in this deal. Just now I also have our other avatar is kind of some that have either exited businesses or maybe some family money, maybe not family office style, but somewhere along those lines where they're big check writers, they could care less about the quarterly distributions. I mean, they don't want their money just not making anything, but they want to know at the end of my 5 years, where will my money be the most? Like where will it, multiply the most? Even if I don't get a check, but on the day, on the anniversary of the 5th anniversary, it's going to be 3x here. And I told them, but you can get 1.7 over here, and it's going to come in evenly quarterly distributions. Their response is, give me the 3x. I don't need the money. So just really depends on that investor, and it's two completely different things based on them.
Yeah, that makes sense. Well, Brian, is there anything else that you wanted to share about this deal or about Fergmar or yourself?
No, I mean, that kind of encompasses the deal. I definitely, if there's ever anyone that wants to talk about, this commercial value add play, I think it's a huge deal. And we're definitely not going to touch every market. And there's some of these buildings in every market. So it's an interesting play. We've learned a lot of lessons the hard way. We've done quite a few of them now, but I'd be happy to visit with anyone, or if there's, anybody that ever wanted. I love connecting with new folks, but that's kind of us in a nutshell and what we got going on.
Where can people hear more from you or connect with you?
So yeah, altunascapital.com is our website, or fergmar.com. My email, bferguson@fergmar.com. You can always reach me there, or you can find me on LinkedIn and most socials.
Awesome. Well, thank you again for sharing about yourself, your businesses, and the deal that we talked about today.
Man, I appreciate it. Thank you for having me on. It was great.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again, and enjoy your day.